Hello, everyone, and welcome back to Sipping Wealth Live, where I bring you news, tips, and tricks on how to wealth up. So, today we are going over some tax myths and some misconceptions about taxes, things like that. So, for those of you that are tuned in with me, make sure that you hit the share button and also make sure if you're streaming from the YouTube channel to go ahead and hit the subscribe button and the notification bell so that you don't miss out on any Sipping Well Tuesdays. All right, y'all. So I'm going to go ahead and get cracking on this topic. Per usual, if y'all do have questions as I'm going over this information, make sure that you go ahead and drop a comment in the comment section so that I can answer your questions. And also, drop a comment anyways. Let me know if you're tuned in with me. Say, hey, girl. Whether you're watching the repeat or you're tuned in right now with me, go ahead and drop a little comment. Let me know who's tuned in with me. Hey. I see y'all rolling in. Just drop a little hey in the comment section. Don't say hey to your girl, so I know y'all tuned in with me. Okay, y'all. So as I wait on y'all to drop your hellos to me in the chat, I'm gonna go ahead and get cracking on this topic. All right, like I said, I'm gonna be talking about some tax myths, making sure that we remove those misconceptions that we have about tax, centering around taxes, and that we get our facts straight. Okay, so to start off, I'm gonna start with this. So some people believe I can deduct my personal expenses if I run a business. Okay, we're gonna go ahead and dial back a little bit because that's not necessarily true. So only if the expense directly related to the operations of your business, meaning they have to be considered like ordinary business expenses, or they have to be necessary for your business in order to be deducted. So my phone, for example. So if I have a phone line directly designated for my business, then that's the phone line that you get to deduct, of course. Now, for example, for my personal phone, maybe I'm doing business from my personal phone as well, and I use my personal phone, maybe 60% of the time for my business, and then the rest of the time I use it for personal. The 60% of the time, that 60% of the phone bill, that's tax deductible. The other 40% is not, because that's personal. So misconception that, hey, I can write off personal expenses if I run a business, there's that margin there, like it just has to be used for business purposes. Okay, so it's not really considered personal expenses because it's used for the business. All right. Okay, next one is going to be receiving a tax refund means you're not going to be audited. So some people believe that, oh, I got a refund, so I'm free and clear. Like, it does, just because you received a tax refund, that doesn't mean that you're free from audit. Just because, like, hey, maybe you're like, oh, all my information's in, or I did an amendment and I have all my deductions and things like that. I'm not going to be audited. That doesn't mean you're not going to be audited. Okay, the IRS can still audit returns, and even when you receive a refund. So refunds can they can go ahead and deduct that take that refund back and audit the return, and that goes up to 3 years and sometimes up to 7 years and longer, depending on what's going on with the return. If there's any fraudulent cases, things like that, the IRS may pull it indefinitely. So they have a time period where they can pull it if it's fraudulent, if they believe the transaction to be fraudulent, or if it's just, hey, they're pulling it for an audit to review some things. And then if you are pulled, say you submit a tax return and you are pulled for an audit and you didn't yet receive a refund, maybe you had to submit a refund amendment in order to get your refund back. then you can go ahead and submit that amendment, things like that. But you do have that 3 year time frame. So after that 3 year time frame, you can no longer claim a refund. Um, you have to like charge it to the game type of thing, and then make sure you do better next time. All right. My next myth: you can avoid taxes by putting your money off in offshore accounts. All right, y'all. All right. Putting your money in offshore accounts. I don't know about that. So, with doing that, just because your money is in an offshore account does not mean you're avoiding taxes. So, not only do you have to report to FinCEN, which is is a foreign financial regulatory board agency, you have to report to the IRS. They want to know. They want to get all up in your business. They want to know exactly how much money is going out of the U.S. into the U.S. So even if you live in another country, but you're a resident, you're a citizen and resident, and you're a citizen of the United States, they want to know everything. Okay, so it is important that you are still reporting to those governing bodies, that you are still reporting those foreign income on your tax returns. No matter if maybe you're living in Canada for a year and then you come back, whatever the case may be, you do have to make sure, as a citizen of the United States, you have to file a tax return. You have to make sure a non-resident return is fine. You have to make sure they are on notice about how much money you're making, even if it's foreign income. And then no, you can't avoid taxes by putting in an offshore account, because not only will they know about it, but they will also make sure, get at you for that money. All right. Next tax myth is going to be: amending a tax return is going to trigger an audit. So because you amend a tax return does not mean you're going to get audited. Now, a lot of times, if there's a huge difference as far as what you're reporting, claims you're reporting on your tax return, it's a higher chance of getting audited. For example, if you in your original tax return you owed $102,000 in taxes, and then you did an amendment, you gave your accountant all your deductions, you said, oh, I had vehicle expense, all this, and now the IRS owes you $2,000 back. So they wiped out that entire $102,000 and some. The IRS is going to want to know if you really got the proof for all those deductions and claims you made against that. They want to know, exactly like, hey, are these deductions and stuff legit? So it is higher chances of you getting audited, but it doesn't mean that you will. And a lot of simple amendments, maybe something like maybe a form was missing, things like that. A lot of times they don't get audited anyway. So usually the discrepancy has to be like larger a lot of times for them to be like, whoa, you're gonna have to provide us with more information. All right. Next one is: my accountant is responsible for my tax returns accuracy. Ooh, this one's huge. So a lot of people believe that, hey, my tax preparer is completely responsible for my taxes. Like whatever they put on is their fault, whatever all that. So even though, hey, your accountant, your tax professional is helping you prepare the return, the responsibility is ultimately yours. So when you sign your tax return, you're signing saying everything on the tax return is accurate. I verified everything's accurate. I take responsibility. So even though that person's helping you file your taxes, it is not their ultimate responsibility if their tax return is accurate. So you do want to make sure before that person sends off your tax return that you verify that they walked you through everything looks good and to your understanding. Because if not, then it's really not their fault. Now, if they have a lot of times, if they have a lot of cases where they're getting hit with people having errors, then they start looking at the tax professional. But usually that takes a lot of cases for them to start looking at the tax professional versus the blame being on the all right. So make sure that your tax return is accurate, y'all, and to your standard, because it is ultimately your fault. Okay. or the blame is on you essentially. All right, next myth I'm going to go over is a tax extension gives me more time because I don't owe. So if you don't owe any money, if you do a refund, and you don't and you file an extension, then essentially you're fine because you have a you're due a refund, so you won't owe the IRS. Now it becomes sticky when you owe the IRS. So even though you have an extension filed, that mean it doesn't extend you having to pay the IRS. You still have to pay the IRS by the deadline, which is for partnerships and S corps. You have to pay them by, even if you have an extension, you have to pay them by March 15th. If you have an LLC, a C corporation, an individual tax return, you have to pay the IRS by April 15th or tax day. It Having an extension does not extend the time period you have to pay the IRS. Okay? It just says you don't have to file your tax return. We're going to give you more time to file the tax return, but you still got to pay them. And if you pay them and you find that, oh, you sent them too much money, then great. When you actually do the tax filing, you will get it refunded. If you find that you didn't send them enough money, then they will charge you penalty and interest on the amount, that difference that they wasn't charged. Well, I got a question in the chat. Ooh, I like questions. Okay. Do you not have to pay taxes on the money that grows inside of a life insurance policy, or when you borrow from your life insurance policy, even if it grows over $1 million in cash value, and you borrow and use that money while you're alive? Oh, that's such a great question. Okay, so life insurance, which is, oh my gosh, Rain Man, great question. So life insurance is one of those things, like, it is a wealth hack. It is a huge wealth hack. No, you do not have to pay taxes on the money that's accumulating in your life insurance policy. Okay. That is tax-free money, tax-free growth. Like, go crazy. If you want to use your life insurance policy as leverage and use that money while you're alive, do your thing. If you want to borrow against your life insurance policy, do your thing. It is a great life hack. It's a hack. Okay. It's a wealth hack. Leverage it. A lot of business loans are actually requiring that the business owner gets a life insurance policy in order to secure the loan. So just if you think about it, if the bank is saying, hey, we need you to get a life insurance policy to secure this business loan, imagine if you already have a life insurance policy and you're able to leverage the life insurance policy to go get a larger loan to grow your business and do your thing. So yes, Rain Man, great question. Leverage the heck out of your life insurance policy. If you don't have one, go get one. If you need a contact, let me know. I got you. But yes, get your life insurance policy ASAP. All right. Next myth is all income is taxed the same way. No. All income is not taxed the same way. You have your ordinary income, and then you have your passive income. And you have passive income versus your ordinary income. Ordinary income is like your income that you're working for. That's the income, that self-employment income. That's your W-2 wages. That's your, things that you're actively working, your earned income. Now, your passive income is going to be your investments. Maybe you own an S corp. Maybe you have real estate investments. Maybe you have stocks, things like that. So when it comes to passive income, there's actually two buckets. So this is going to be, the passive income is going to be taxed, is going to have capital gains tax in general. So depending on how long you hold those assets, those investments, that passive income or things like that, is going to determine whether or not you're going to be taxed at the regular tax rate, ordinary tax rate, or if you're going to be taxed at the capital gains rate. So the great thing about capital gains rate, which is a long-term capital gains rate, is that it's capped. So you have 0, you have 15%, and then it's not going to get up to, well, unless they change the laws, it's not going to go up to that 30, 35, 37 percentile, which is great. So those long-term capital gains, it's like an incentive that, hey, we want you to have more capital. We want you to have more investments that you're holding for a longer period of time. So we're going to give you a tax break. So that's why those long-term investments are taxed at the capital gains rate versus the regular income tax brackets. All right. Y'all, this live right here, y'all should be sharing this because I'm going up with some gems tonight. Ooh, I'm excited. Okay. Okay. All right, next myth is going to be you can't deduct charitable contributions if you don't itemize. Okay. So, with the fact around that is with there's an increase in standard deduction. Now, charitable contributions can still be deducted under certain conditions. So, I highly recommend, because this gets touchy, to make sure that you're speaking to a knowledgeable tax professional about which charitable contributions this fit in, because if you're doing like regular charitable contributions, maybe to a church tithing offering, then that's going to be fall more under the itemized deduction shebang. But depending on depending on what you're donating, properties, things like that, assets, depending on what you're donating, what charitable contributions you're making, could actually apply even if you don't itemize your tax return. Okay, so a little caveat there. All right. Next one is going to be married couples must file jointly. Okay, married couples do not have to file jointly. Okay, you can't. Married couples have the option of filing separately as well. So, and then and they're but they tend to file jointly because of the tax benefits. There are more tax benefits when they file jointly a lot of times than, because they start phasing out. They start not being able to take advantage of certain credits when they're filing separately versus jointly. So that's the big thing with making sure that married couples are filing jointly versus separately, but they do not have to file jointly. Okay. Next myth is tax refunds are a good thing. All right. So tax refunds are not necessarily a good thing. It just means that you overpaid your taxes during the year. You know, that's all it means. But it also means that, hey, you're giving essentially an interest-free loan to the government. But God forbid you didn't pay them by tax day, you're going to be hit with interest and penalty. So they don't wait on their money. But if you want to give them extra money throughout the year, they will gladly take it. So tax refunds are not necessarily a good thing. They're just looked at as a good thing because people like to receive a refund at the end of the year or at the beginning of the year, because they're like, oh, I got an extra money in my pocket. But in actuality, it just means you let the IRS hold your money, the government hold your money throughout the year while you're doing your thing. But a lot of people tend to like that versus having to pay the IRS at the end of the year and be hit with a tax bill. So the better is to get as close as possible to what's the amount that you're going to owe the IRS. That's why it's good to make sure you have a tax plan at the beginning of the year, so that there's not a huge gap between the amount you're overpaying the government versus the amount that you're actually going to be owing to the IRS. Because imagine that refund that you're receiving. Okay, you got a tax refund, $7,000, $8,000. Imagine if you put that $8,000 in a mutual fund. Just simple. Imagine if you put that $8,000 in fund last year at a 5% growth rate, 5% interest rate. Now you're receiving 5% on $8,000 versus, giving the money to the IRS interest free. So that's the caveat with getting a refund versus not getting a refund, that thing. All right. Next myth is you do not have to report income if you are paid in cash. Okay, y'all. So yes, you do have to still report all you have to report all income. When I say all income, they don't care if it's illegal or not. They want you to report all income. They don't care if it's bartered services. If I wanted to get my house painted and my painter wanted tax preparation for free and we did a barter service, that is still taxable. Okay. So they want some of everything. So everything's taxable. All income, cash payments, everything must be reported to the IRS. Yes, whether legal or not, they want a piece of every pie. Now, if you report illegal income, that doesn't mean that you're going scot-free as far as the illegal activity, FYI. All right. Next myth is going to be money earned online doesn't mean to be reported. Yes, yes, yes. Money online, like I said before, all income, whether you made it cash, online, Facebook paid you because you made amazing content, whatever the case may be, you have to report. If you most grants, a lot of people don't know this, but most grants are taxable, unless the grant is going into a not-for-profit organization. That's taxable income. Okay, so make sure that you are reporting all income. All of it is taxable. All of it must be reported, and that shebang. Next one is going to be home office deductions are a red flag for audit. Home office deductions are not. Home office deductions are completely legal. It just, you do have to make sure that you are properly documenting the space that you are using for business versus like your office space versus your home space. Like my home office, I use for my business. So even though I have a location in San Marco, I still deduct this home office space because I use this more than 90% of the time, literally 100% of the time for business. So this is still deductible. All right. I got another question. Okay. If two business owners have the same type of business, make the same gross profit, and have the same expenses, but one is an LLC and the other is treated as an S corp, is the business owner that is an LLC treated as an S corp not able to legally pay less in taxes? So so this is what happens if one business owner is an LLC versus the other business owner is an S corp. So the business owner that's an LLC, they get hit with self-employment tax. That's just what it is. They can't like take a W-2 or things like that through their LLC. They would just report all income as their business income as self-employment income. But with the S corp, being an S corp status, you legally have to be on payroll as the owner. Okay, being that you can afford to be on payroll. If your S corp can't afford to put you on payroll, then obviously there's no money to put you on payroll. But if you do have enough revenue going through your S corp, then you have to be on payroll because you are not self-employed. You are employed by the S corp. So with that being said, the owner that's an S corp, they're a W-2 employee. They just get paid from their S corp, and that's it. The S corp get paid from the partnership, and then the S corp pays out the owner through a W-2. The owner can also take owner draws, things like that. But that partner that has the LLC, all the income that they get paid from the partnership is self-employment income. So it will get hit with self-employment tax and then ordinary income tax as well. Hopefully that answers your question, Rayman. Ooh, let me know if you still have questions surrounding that. Okay. Next myth, I have a couple more. Ooh, I got two. I got three more, y'all. Three more. Okay. Okay. So next one is students are not required to file taxes. All right, students, you have to file taxes if you are over that income threshold, that earned income threshold. So he said it did. You're smart. Thank you. Yeah, I'm glad it helped. I'm glad it helped. Awesome. Students, yes, you still have to file taxes. If you're over the standard deduction, which is now about, let's say 13,000 this year, it's like 13,200. It's like 13,200, but yeah. So 13,000. Say you only made $13,000. You don't necessarily have to file a tax return, but you can file a tax return if you want to file for a refund. But other than that, you're good. Also, can my parents still claim me as a dependent? Your parent could still claim you as a dependent even if you made that 13,000, even if you made 16,000. Your parent just has to be providing more than 2/3 of your living, your means to live, and you can't make more money than them. You can't make more than 2/3 of the amount that they make. And they have to be contributing majority of your living, like to your living income, to your living standards. Okay. Um, Filing taxes is voluntary. Voluntary. Ooh. All right, that's the next myth. Next myth is filing taxes is voluntary. So legally, filing taxes is a requirement for individuals and businesses if they are of a certain income, if they meet a certain income threshold, and that's investment income, earned income. There are certain income thresholds, $400 for businesses, things like that. If you meet that threshold, then you are required to file a tax return. All right, and the last one. I think that was the last one. Yeah. Okay. Taxpayers in the highest income tax bracket pay the most taxes. All right, y'all. Okay. So even though high income earners do pay a huge amount of income tax, um the like the tax system is like the tax bracket system is like progressive. So it could mean that the amount of money that's they're being taxed at 37% is only $5,000 because they just hit the 37% tax bracket. So it's on a bracket system. So the first $10,000 or 9,000 is tax free. Then the next 20,000, I'm using numbers, range numbers, just to give you an idea of what it looks like. Then the next $20,000 is going to be taxed at 10%. Then the next $30,000 will be taxed at 12%. So that's how it works as far as how you're being charged taxes. It's not that, oh, my tax bracket, I'm at the 17% tax bracket. All my income is taxed at 17%. That's not how it works. It's like, it's each level. Whichever income is in that level is how much that portion is going to be taxed at, and like that. So hopefully that makes sense as far as how you're calculating your taxes. Because even though that bracket, you may hit this tax bracket, that is not necessary. That is not your actual, like how much taxes you're actually paying. All right, y'all. I went over quite a few tax myths. Make sure that you share this live with your friends, families, followers. Make sure that you are subscribing to the YouTube channel. If you do have questions, things like that, let me know. Also, If you do have suggestions for future lives, make sure that you drop it in the Sipping Wealth Facebook group, and we'll make sure we look at that as well. Next week, I will be going over behind the scenes of tax preparation. So, what does that look like? So I'll be speaking to you all about how it looks like step by step of the tax preparation flow, and demonstrating like how I would go through the system, go through preparing the returns for my clientele. I'll go through individual basis, certain some of the questions that I'll be probing and asking, so that you would know when you file your sit down and file your taxes, okay, I need to be looking out for this, or I need to make sure I have this information ready because I know that that's going to be required by my tax professional. So I'll be going over that next week. So behind the scenes, and I will show y'all the amazing office as well. So see y'all then. Make sure you are tuned in next week for another episode of Sipping Wealth Live. Thank you for tuning in again. You all have a wonderful evening.